Jackson Hole has come and gone, and the market's on all-time high watch. Let's talk about it on the Weekend Update. Okay, friends, let's talk about the market. Here's what you need to know. First up, we're actually going to do the news first here, and we've got to talk about Jackson Hole. So today, Jay Powell at 10 a.m. spoke at Jackson Hole, and this is really where he sort of gives his viewpoints on the economy. He talks pretty broad here, but this Jackson Hole, it was widely expected that Jay Powell was going to signal a change in Federal Reserve policy and the rate hiking regime and the inflation fighting regime that we've been in. So let's take a look and see what he said. First up, just the highlights of what I think are the important parts of his speech. First up, my confidence has grown that inflation is on a sustainable path back to 2%. This is what Jay Powell, said this morning at Jackson Hole. So what does this mean? Well, if Jay Powell's feeling confident, that increases the likelihood that we're going to start to see some rate cuts here in the not too distant future. Second, he starts talking about the labor market here, and this is important because the labor market was pretty much the number one area. Prior to this, Jay Powell was hesitant to signal, rate cuts were coming because there wasn't enough slack in the labor market. So let's take a look and see what he says about it now. Hiring and quits rates are now below the levels that prevailed in 2018 and 2019. Nominal wage gains have moderated. All told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. So what he's telling us here is he's saying, hey, these conditions are consistent with us hitting our mandate. And so what we don't want to do is we don't want to go any further, right? He says it seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in the labor market conditions. So this starts to tell us, okay, what the Fed is going to look at going forward, probably as a guide for their rate cuts, it's going to be the labor market. It's not necessarily maybe the way that I would do it. The labor market, infamously is you looking in the rearview mirror while trying to drive, but that's what he's going to be looking at. He doesn't want the labor market to cool any further. And then finally, he just kind of hits the nail on the head here. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on the incoming data, the evolving outlook, and the balance of risks. So here he's being very explicit. The rate hiking cycle has ended, and we are now entering into a rate cutting cycle. He's not giving us any forward guidance as to how fast or slow this is going to be, but if we get a sense of where his model is or where his mind is at, he's going to be looking at the labor market. If the labor market continues to weaken, if we continue to see slack developing on the labor side of things, I think it's a pretty safe bet we're going to continue to see rate cuts, and that's good. That means medicine is coming to the market. We've been talking about an economic slowdown. We've been talking about an economic storm. So what this is the doctor coming to us and saying, hey, I'm going to start giving you some medicine here. All good. Unsurprisingly, on the basis of these comments, the market has had a field day with it. It's been pretty good. Strong week. We had some jitters going into Jackson Hole. Those have mostly, taken care of themselves now, and the market continues to march higher. It looks like, my model of us having a test around the 50-day, that looks to be correct. And as of today, right now, it looks like this 50-day test is going to resolve to the positive side, and the market's going to be off to the races, continue marching higher. Looks good, all told. What I expect to have happen from here, as we exit this 50-day test, I'm expecting election jitters to start to come into the foreground more detectably. I think there's been a little bit of election jitters here and there, but for the most part, we really haven't seen, what the normal election cycle looks like. So I'm expecting that the next development for the market is maybe a little bit of a soft patch immediately prior to the election. That would fit with seasonality trends, and that would certainly fit with, if you look at some of the discourse around the fringes of, how this election is going and what it means for corporate policy in the markets. I'm going to expect that there's going to be a whole bunch of things for us to be worried about as we move forward into September and October. I would characterize these things, though, as worries, right? Not things that are actionable, not things that we really want to, get out of the way of. Remember, don't mix your investing in politics. But I could see the market getting a little bit worried here, especially since things have been so strong on a year-to-date basis, and the market is so richly valued here. We've got all this good news ahead of us. That means that the only thing that can happen from here, probably some bad news that we weren't anticipating. So there you go. I expect September and October to be bumpy, but this was a fantastic week. We are now in a rate cutting regime, and we'll see how that works from here. I'll see you next week for the news review. Enjoy your weekend. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.